Hi folks, welcome to another session of Investment Income for Life. Netlink Trust seems to be back to a free cash flow deficit position again for FY 2023. This means that it is borrowing from bankers to finance its capex, or if we put it bluntly, this means that part of the distributions back to unitholders for FY 2023 is being funded from borrowings instead of earnings and will not be sustainable in the long run. I initially thought that this issue has already been resolved 3 years back, as I understand that in one of the previous AGM, the management had mentioned that they will pay out distribution after taking into consideration the free cash flow. Folks, before we proceed further, please help to click like and subscribe in order to support the making of more of such contents. 1. FY 2023 distribution more than free cash flow again. From the above computation screenshot using FY 2023 full year numbers, the free cash flow generated is 157 mil. However, it is paying out dividends of 204 mil, which exceeds the free cash flow by 47 mil. The gap most certainly would have come from additional bank borrowings, so next step would be to drill down further for a sanity check using alternative verification on the distribution statement as per below screenshot. From the distribution statement, we can see that Netlink Trust incurred capex of 97 mil for FY 2023. At the same time, Netlink Trust repaid a loan of 156 mil but strangely draw down a higher amount of bank loan of 225 mil, which is an additionally 70 mil. Therefore, we can conclude that most of the capex is being funded by bank borrowings, or alternatively, we can also infer that 23% of the distribution is being paid for with bank borrowings, since the existing cash flow is insufficient to finance such payout. 2. Is there anything wrong with paying for capex using bank borrowings considering the low leverage ratio of Netlink Trust? This is the question that is tough to answer. The only way that Netlink Trust can grow its income is through organic growth, as we have not seen any major M&A deals after many years. Netlink Trust did indeed have growing revenue over the years, albeit at a very slow pace. There is also the upcoming rates review by the Infocom Media Authority that is expected to increase the rates by 2% to 3%. From an annual revenue of 400 mil and assuming ceteris paribus, this will at most increase the free cash flow by 12 mil, which still leaves a significant gap to plug the 47 mil deficit. Manulife US REITs used to be paying for capex using bank borrowings, as their management, via their investor public relation, mentioned that their gearing of 40% then is far from the 50% MAS statutory limit. But look how they ended up. I would rather Netlink Trust management adopt a more conservative stance despite the resilient revenue from its business. 3. Parting thoughts. Clearly, from the above-mentioned points, this kind of payout is not sustainable in the long run if the capex remains high and pricing increase after the IMDA review is only 3%. The bad news is that the distribution yield will drop to 4.72% instead of the current 6.13% if Netlink were to purely pay out its dividend using free cash flow. Nevertheless, the good news is that if Netlink managed to get a higher rate hike increase from IMDA due to the severe inflationary pressures, and if capex came down, then the 6.1% distribution yield will still be sustainable for the longer term. That is all for today, folks. Have a great week ahead.